We're going to talk about Chapter 12, which is discuss investing in stocks. Owning stock is probably the most basic form of corporate ownership. Owning stock is often called equity financing. Firms issue sheets of paper that give some tiny fraction of ownership to the individual who owns the share, and the firms who issue that will use the money they raise via issuing stock to finance expansion and development of their products. There are two general classes of stock. The most frequently or the most commonly held type of stock is called common stock. Corporations will issue common stock when they want to raise money. So again, you actually sometimes have corporations who have been around many years, decades, and will then issue more stock. Most often, you hear companies issuing stock relatively early in their development, and that's when they're trying to start their business. Sometimes corporations will issue new stock in order to pay business expenses. So for instance, they want to build a new factory someplace. They might issue 1 million additional shares of stock in order to raise money. Note that when firms issue additional shares, it does dilute the value of the existing shares of stock. So there is a trade-off for companies to issue additional shares. One thing about issuing stock versus, say, raising money via a bond, when you issue stock, you actually don't have to repay the money. So let's suppose a corporation has two options. One possibility would be to issue $100 million of bonds in order to build a new factory, or it may offer new shares that they believe will raise $100 million. If you use a bond to generate some additional money for your firm in 20 or 25 or 30 years, whenever the duration, the maturity of the bond comes due, you're going to have to pay the principal back plus all the interest. If you issue stock, all you've done is spread the ownership of the company along a larger base, but you don't actually have to pay back the money. Many companies who issue stock give dividends. So dividends will be, you can consider it like an interest payment on owning the stock. So for instance, if you own a share of Apple, you might get $1.50 each quarter for each share that Apple has, that you own of Apple. Dividends are not mandatory. Companies sometimes give dividends just 1 quarter a year. Sometimes companies give dividends for 2 or 3 years and then stop giving dividends. Dividends on common stock are something that you'd like, but you can't count on. The board of directors of the company votes on each dividend payment. So depending upon other issues in the company, like if things are going very well, they may continue to issue dividends or even increase the dividend. If there are challenges in the company or there are anticipated large expenses, they will decrease or even eliminate the dividend. Now, shareholders do have voting rights, and they elect the board of directors. So, in theory, if you're unhappy with the fact that a dividend was cut, you could try to vote in a new board of directors. That's something that rarely happens. Investors, why might you purchase common stock? Well, there are 3 reasons. I would say the first 2 are the main reasons. One is the income flow from dividends. Okay, and so you own stock, but if every quarter you own stock in a company that issues dividends, you can get a flow of income from that. And this is especially historically was a very popular thing for retirees to do. So they'd want to buy stock in the companies that were known to have large and regular dividends, and so they would use their dividend checks to finance their living expenses while they're retired. The second reason, in my own view, the main reason why you'd buy stock is that you're hoping that the value of your stock rises over time. That's called a capital gain. And historically, dividends and capital appreciation were kind of about equal in your total return, but over the last 30 years or so, dividends now account for a smaller and smaller amount. More and more companies either don't give dividends or give smaller dividends. And so the main way investors make money from stock now is via the rising value of the stock. A third possibility is that companies will issue a stock split. And so, for instance, they might say we're going to do a 2-for-1 stock split. So that is, if you own 100 shares, then as of June 1st, it's now 200 shares. And when a company does a stock split, the price of the shares will fall by the multiple of the split. So, for instance, in a 2-to-1 stock split, the price of the share will fall by 50% the day the split happens. So if shares were selling for $40 a share, they would not then, after the 2-for-1 split, be selling for $20 a share. Why investors often like stock splits is when you split a stock, the price goes down, and that actually allows for some investors to be able to purchase the shares when previously it was too expensive. So, for instance, there are some shares of companies that sell for more than $1,000 a share. So there may be an investor who'd like to buy some Google shares. Google at one point was selling for $1,000 a share, where you might only be able to buy 2 shares of Google when it's $1,000 a share. But if Google did a 5-for-1 split, and the day of that split, the price went from $1,000 to $200, there'll be more individual investors who would be able to purchase, and that might drive up the price of the stock. I will say that my own opinion, given that most stock is owned by institutional investors, not individuals, institutional investors don't have that same kind of liquidity issue of high prices limiting their ability to purchase. As a reason to purchase stock is a stock split is probably, from my own mind, not a very persuasive reason why you'd buy. It's really issue number 2, appreciation of stock value, and then second place would be dividend income. There's another class of stock called preferred stock. Preferred stock, in some ways, is similar to common stock, but it has a few advantages. Number one, that dividends declarations for preferred stock are different than the dividend declaration for common stock. Common stock has much more quarter-to-quarter variability in dividends, whether it's either given or whether it changes. Preferred stock, very rarely, you basically have a guarantee of a certain dividend flow if you have preferred stock. So people sometimes prefer dividend stocks because they feel that they're going to have a more assurance of the dividend flow. But again, because many companies have really reduced the amount of dividends they issue, this is now no longer a persuasive reason to buy preferred stock. One reason companies or individuals like to buy preferred stock is if a company is having financial problems and goes into bankruptcy. The people with preferred stock will be receive again, if the company is liquidated, they come ahead of common stockholders, and so there's more assurance if you're buying a company that's kind of potentially could go bad. One drawback of preferred stock is kind of offsets this attractiveness of kind of known dividends and potential value in liquidity when a company dissolves. Is that the drawback is you often dividends preferred stock does not have voting rights, or they have different voting rights than common stockholders. So there's often a drawback. You have less of a say of how the company operates. Now, if you were thinking of buying a stock, how would you evaluate whether or not you should actually purchase your stock or not? There is literally a whole entire course, or maybe a series of courses we could do on this particular issue. So we're really just touching the basics of it. One question you have to ask is whether you're a speculator or an investor. And there's a large literature in economics and finance that the price of a company at any time contains the information that investors, all the investors in the market, have about the individual company. So if a company is currently at $40 a share, if it's known, widely anticipated by the market, that the price is going to go up, immediately today, the price of that share, that stock, is going to be bid up. All right. And on the other hand, if there was known in the market by many investors that the price was going to go down, the price would almost immediately go down today. And so the idea is in general now, in the modern, highly efficient stock markets, it's just as likely at any given price that a share price is going to go up as it is that it will go down. This is in economics and finance something called a random walk hypothesis. It actually is borne out in the data. So speculators often feel that they have more information about a company, and they're going to buy thinking that they're going to be able to, the shares at $40, I think it's going to move to 43 in a relatively short period of time. An investor, and the way I use the term is an investor basically buys a company thinking that in the long run, the income flow from dividends or the long-term earnings, the corporate earnings the company is going to have, is going to increase the value of the shares. So Warren Buffett is an investor. Warren Buffett is not a speculator. He buys companies for their long-run value. In order to be an investor, there's a lot of research. You got to try and really figure out what's going on with the company in terms of long-term ability to generate earnings and pay dividends. One serious problem that most, I would say, casual investors have is they watch too much cable news and read financial news, feeling that the news that they get by watching CNBC or Fox Business News or the Wall Street Journal they're going to be able to, by reading that, be able to make money, therefore follow the recommendations. The problem is by the time you're either hearing it on television or read it in the paper or in a magazine, that news is really not news to the market. So, for instance, in CNBC, if you're hearing a story about some research analyst views of Apple, the market already knows everything. The experts in the market already know everything that person is saying, and it's already incorporated that information in the price. It might be news to you, but it's not news to the market. So it's really huge caution needs to go out to anybody following advice that you're hearing or reading in magazines, in newspapers as a basis to buy or sell a stock. That news is old and it's already incorporated into the price of the stock. So there's dozens and dozens of magazines, and so here I just went and cut a couple pictures of, the Kiplinger's, Forbes, Business Week, Investors Business Daily. They're in the business of getting you to purchase their product, which is the magazine. That's what they're trying to sell you. So the headlines and the articles trying to tell you they have got inside information for you on how to improve your investing returns, that's mostly marketing from them in order to generate magazine and newspaper sales, or in the case of CNBC and Fox News, generate eyeballs watching the show. There's very little, essentially no real new news in any of these publications. So the bottom line is it's very difficult when you're purchasing stock. Remember, when you're purchasing stock, you're often purchasing from someone who wants to sell the stock. So they must have some information that makes them feel that it's no longer a good stock to hold. Very, very difficult to project forward about how a stock is going to move in the relatively short term. What kind of numerical measures do people use? Well, one is companies look at earnings. Investors look at earnings. So one of the things that investors often look at are what is the earnings a company reports, and it often therefore changes the value of a stock. So these quarterly earning reports, personally, I think they pay too much attention to them, these investors, but it's a significant amount of information investors feel is contained in that. Earnings per share will be this reported of, we made $100 million last quarter, and you divide it by the number of shares, and that would be the earnings per share. One measure that many people look at is what's called the price to earnings ratio. So price would be the price of the share, and you divide that by the firm's earnings per share. And it basically is a metric that if you're willing to pay, the numerator is the price and the denominator is the earnings per share. And it gives you an idea about how much an investor is willing to pay for the amount of earning power, which is the denominator. So in the modern world, kind of a break-even point people often talk about is 20. A price to earning ratio greater than 20 means the people purchasing that stock are willing to pay a high 20 times their earnings flow for that share, and less than 20 means lower earnings expectations. The 20 as a breakpoint, though, I should say, is high by historical standards. Traditionally, a price-earning ratio for the S&P 500 was about 15. It's clearly higher now, but you might want to look at price-to-earning ratios. So it gives you an idea of how long. If you buy a company with a PE ratio of 20, that gives you a sense of how long it's going to take till the earnings are going to compensate you for the price to purchase the share. So you want to compare that to either firms in the same industry or in some absolute scale. There are two different ways people think about price to earning ratio. So, for instance, you may say you're not interested in buying companies with a price-to-earning ratio greater than 15 or 19 or 20, right? Different investors have different cutoffs where they kind of feel that a PE ratio above a certain number, let's say 21, is just too high. You're paying too high of a price for that income, the earnings flow. Now, this is something that many investors look at. Certainly it's something that Warren Buffett has talked about in the context especially of kind of high-tech companies. So Facebook, for instance, has a PE ratio of over 100. Okay, so you can imagine two companies. One is a traditional company, let's say IBM, with a PE ratio of 12, and you have Facebook with a PE ratio of 100. So if you're going to have a PE ratio of 100, that's the current value of the price to earning ratio, that must mean that investors anticipate a significant increase in earnings in order to justify paying such a high premium today for Facebook. Amazon's PE ratio is over 1,000. So again, that is a really high number. Amazon has very small earnings, right? And at the current price of Amazon, it's over 1,000, the PE ratio. So that's going to give you an idea that it's going to take a long time at current earnings for an investor in Amazon to get back the price he or she's paid. Now, 1,000 to me is an amazing high number, and it would be way, way too high. I would not feel comfortable buying Amazon. But some companies that receive a lot of attention, like Twitter, Groupon, Zynga, Zillow, I just looked these up. They have PE ratios of over their infinity, right? As their earnings are essentially zero. So right now, there's no prospect for the flow of earnings to compensate you for the price you're paying in Twitter, right? So Twitter, why people are investing in Twitter has to be that they have some view in the future, not currently, that Twitter's going to be able to generate earnings and very high earnings to justify the price you're paying for Twitter. So you'll find many investors not purchasing any of these kind of new tech stock companies because the PE ratios are not just 22 or 25, but they're actually over 100 in the case of Facebook, over 1,000 for the case of Amazon, and essentially infinity for somebody like Twitter. Other metrics people look at is the dividend yield. Okay, dividend yield is the annual dollar dividend divided by the current price per share, okay? And then the total return would be your dividends plus the capital gains, right? And so many investors now make their decisions about whether a company is a good buy or not by looking at just the capital gains, that is your price appreciation, which is largely driven by the idea of this, or how much earnings the company can generate for you, and dividends. They combine them together for your total return. My own view, that is the proper way to think about what a stock is generating for you. An important metric in terms of how you evaluate a company is this something about the book value. So the book value of a company is you would take the total assets of the company, subtract away all the liabilities, okay, and then you divide that difference by the number of shares. So asset minus liabilities for an individual is like the net worth of the individual, and you divide it by the number of shares. That kind of gives you the net worth of a company per share. That's called the book value per share. And it's often the case, in fact, typically the case, that the market price is often far, far higher than the book value. Okay, and again, this is a metric that some individuals use for how attractive a company is to purchase, right? If the book value is $3 per share, but the current market price is $20 per share, right? So the ratio of 20 to 3 is, over 6, and that may make them think about not purchasing that company, right? So you want to compare that market price per share with the book value. When you buy and sell stocks, there's two ways you can do it. The way you sometimes hear about is the primary market, and that's when a company issues new shares in a company, either the initial public offering or when it dilutes its existing shares by adding more shares to the market. You're buying effectively directly from the company, and the earnings from that go basically to the company. Most of the shares people are buying or selling are on the secondary market. So at some point, someone bought shares in Amazon. They no longer want to hold the shares in Amazon, so they sell them. Okay, to sell that, you'd go through a broker. So, for instance, common brokers would be Fidelity, Schwab, Vanguard. Okay, you have an account with them. It's like a bank account, but instead of having dollar bills in your bank account, you will have shares of companies in your accounts with them, and you can issue buy orders or sell orders. In the secondary market, the transactions are between individuals. Basically, one set of individual wants to sell. They're willing to sell Amazon shares at the current price, and there's another set of individuals who want to buy Amazon at the current price. Okay, and the transactions are handled by brokers and dealers for you. And so there's going to be a cost associated when you buy and sell stock, okay, because there's a broker and dealer margin they have to pay. Okay. A common thing that many people do when they invest, whether it's in shares, mutual funds, or bond, is do something that's called dollar cost averaging. All right, and the idea here is that if you regularly want to invest, and you might be thinking about this as, for instance, investing for your retirement, the way to think about investing is not, I'm going to buy 5 shares each year. Rather, what people recommend is what you think about is putting aside a certain dollar amount per period and use the dollar amount as the basis. And what that means is when the price of a company goes up, you'll buy fewer shares. And when the price of the company goes down, you'll be able to buy more at that fixed amount. And so what it does is it encourages or induces you to actually buy more shares when the price is down. Let's look at the table I have here on this slide to highlight this. So in this table, each year I have this person investing $2,000. Okay, and so that's the idea. You're going to save $2,000 in investments each year, okay? And you're going to invest in a company, and hypothetically, let's suppose this is Amazon, and in 2010, the price might be $60. In 2011, it goes up to $68, and then in 2012, it goes down to $58, okay? Now, when you dollar cost average, the $2,000 buys different numbers of shares depending upon the stock. So when the share price is 60, you're able to buy 33.3 shares. When the price goes up to 68, so the price is higher, 2,000 divided by 68 is 29.4. So again, you avoid buying too many shares when the price is high. And then in 2012, when the price goes down to 58, 2,000 divided by $58 is 34.5. So notice you buy more shares in 2012 when the price goes down. So dollar cost averaging is a disciplined way to try to encourage you to buy low and sell high and avoid the idea of buying lots of shares when the price goes up. Okay, so for long-term investors, dollar cost averaging is a good way in terms of saving and investing because it induces this desirable property of getting more shares when the price goes down.